Listen closely, because what we witnessed in the gold and silver markets this past week was not just a fluctuation on a screen. It was the kind of decisive, violent move that rewrites belief systems in real time. For months, you have been subjected to a relentless chorus of skepticism. You have heard the experts, the pundits, and the financial media repeating the same tired narrative. They told you that the top was in. They told you the rally was over. They dismissed the price action as a blow-off top and warned you to get out while you still could. They spoke with the absolute confidence of people who believe they understand the machinery of the market. And then, as it so often does, the market did the one thing it truly loves to do. It humiliated certainty. Gold and silver did not just hold their ground against this wall of skepticism. They pushed back. They broke through critical resistance levels. They printed fresh highs with a velocity and momentum that has forced even the loudest doubters to lower their voices and reconsider their reality. Most people have not yet processed the significance of this move. They see a green number on a chart and think it is just another trading day. But these were not random spikes caused by a temporary glitch or a singular news event. This was follow-through. This was confirmation. This was the market looking at the global economic landscape and explicitly stating that it is not finished. The price action we are seeing is the financial equivalent of a tectonic shift. Silver, in particular, had one of those weeks that rarely shows up on a long-term chart. Even after giving back some gains late in the week, the sheer magnitude of the move serves as a violent reminder of why silver is not a boring metal. It is a coiled spring. It is an asset that can remain dormant for years, testing your patience and your sanity, only to move in a way that fundamentally changes your financial planning horizon in a matter of days. Meanwhile, gold is doing exactly what gold is designed to do when the world becomes messy and unpredictable. It climbs while people argue about politics. It climbs while the stock market tries to maintain a party atmosphere despite deteriorating fundamentals. It climbs while central bankers pretend that inflation is under control and that the economy is robust. It climbs while the average person is distracted by entertainment and trivialities. Yes, the S&P 500 is up, and the mainstream financial news will tell you that everything is fine, but that everything bubble does not look quite so heroic when you change the scoreboard. When you measure those stock gains against the rising price of hard assets, the illusion of wealth begins to fade. We are entering a phase where the currency itself is the variable. And if you are not paying attention to this shift, you are risking your financial future. Today, we are going to dismantle the false narratives, analyze the true drivers of this market, and confront the uncomfortable reality of what happens when the financial system begins to close the exits. To truly understand the gravity of this moment, we must first dismantle the lazy analysis that is currently circulating in the financial community. There is a specific narrative that chart watchers and analysts have been selling since late December. They looked at the highs, drew a line across the top, and confidently declared a double top. They clipped the chart, posted it on social media, and spoke with the arrogance of hindsight. Their claim was simple. That was the ceiling, the bull run is done, and gravity is about to take over. But a real market top does not behave the way we have seen this market behave. When a market truly tops out, the reversal is not polite. It is not a gentle hesitation. A real top is followed by immediate, loud weakness. The air comes out of the balloon instantly. Buyers disappear. Volatility turns ugly to the downside. And most importantly, the market cannot reclaim the high with authority. What we just witnessed was the exact opposite of topping behavior. We saw the price tag the old high, hesitate just long enough to bait the bears into shorting the market, and then rip through that resistance level with overwhelming force. That is not how a dying market acts. That is how a breakout market acts. This distinction is critical because it tells us about the underlying psychology of the capital involved. We are looking at weekly closes, not just intraday noise. Intraday spikes can lie to you. They can be driven by algorithms and high-frequency traders. But weekly closes are where conviction shows up. A weekly close at these levels indicates that big money, institutional capital, sovereign wealth funds, and central banks is setting its footprint. When silver moves as far as it did in 5 sessions, it is not because a few retail investors got excited on a forum. It is doing it because liquidity is thin and demand is persistent. We need to address the historical comparison that everyone keeps making. You keep hearing people scream 2011 every time gold or silver makes a run. They point to the crash that happened after the 2011 peak and warn that we are on the verge of a similar collapse. This is a fundamental misreading of history and economics. Markets repeat themes. They do not repeat scripts word for word. The conditions that created the 2011 peak are radically different from the conditions we are living in right now. In 2011, the world had just emerged from the global financial crisis. There was a sense that the worst was over. More importantly, interest rates were at the bottom of the cycle and were about to start rising. Major cycle tops in precious metals typically do not happen until the interest rate cycle has bottomed and turned. The easy money phase creates the lift, and the tightening phase usually marks the end of the party. Look at where we are today. We are not in a world where rates have definitively bottomed and reversed higher to restrictive levels that will be maintained for a decade. We are in a world where rate cuts are openly discussed, priced in, and expected by every major financial institution. The Federal Reserve and other central banks are signaling that the next move is likely toward easing, not tightening. As long as the narrative is about cutting rates and injecting liquidity, that this is the top narrative is premature. We are likely living through the acceleration phase, not the terminal phase. The structural forces that drive metals higher, debt, money creation, geopolitical tension, and the weaponization of finance, are not solved. In fact, they are significantly worse than they were in 2011. In 2011, there was still a lingering belief in global cooperation. There was a perception that major powers would act as stabilizers. Today the world is fractured. Trade is weaponized. Supply chains are political. We have moved from an era of friendly globalization to an era of defensive nationalism and resource competition. In this environment, gold and silver are not just commodities. They are trust meters. They are the scoreboard for policy credibility. When nations no longer trust each other's currency or debt, they turn to the only neutral reserve asset that has no counterparty risk. That is why central banks are buying gold at a record pace. They are not speculating on price. They are de-risking their reserves from the US dollar system. This is a structural bid underneath the market that did not exist in the same way in 2011. Furthermore, we must discuss the concept of benchmarking, because this is where most American investors have a blind spot. Most people only evaluate gold and silver through the lens of the US dollar. They look at the spot price in dollars and assume that tells the whole story. But the US dollar is not the world. It is a major piece of the world, but it is not the entire picture. If you want to see the future, look at what has already happened in other currencies. In Japan, in Turkey, in various emerging markets, gold has not just made new highs, it has left the old highs in the dust. The previous peaks are distant memories. When you benchmark gold against a basket of global currencies, you see that the US is not leading the charge. It is catching up. This is simply how currency math works. If your currency loses purchasing power more slowly than the Japanese yen, your gold chart will look calmer for longer. But eventually, the same pressures, deficits, debt monetization, and inflation will hit the dollar. When that happens, the chart snaps. We are seeing a catch-up trade, where the US dollar price of gold is realizing what the rest of the world already knows. The purchasing power of fiat currency is eroding at an accelerating rate. This brings us to the uncomfortable reality of realistic price zones. If gold is accelerating toward a catch-up move relative to global inflation and currency debasement, we need to mentally prepare for numbers that sound impossible to the uninitiated. A run towards the mid-thousands for gold is not a fantasy. It is a mathematical probability if the currency backdrop continues to weaken. For silver, moves beyond triple digits are not science fiction. We are talking about a market where investment demand is colliding with industrial demand in a way we have never seen before. Solar panels, electronics, electric vehicles, they all require silver. The industrial consumption is devouring the supply, leaving less and less for the investor. When you combine a physical shortage with a monetary panic, the price response is not linear. It is exponential. However, we must be careful with our expectations. Price does not go up in a straight line. Silver, especially, is designed to test your conviction. It will have violent pullbacks. It will drop like a rock just when you think it is safe. This is part of the psychological warfare of the market. But a pullback is not the same thing as a cycle top. A pullback in a bull market is an opportunity to accumulate, whereas a crash after a top is a wealth-destroying event. The difference lies in the fundamental drivers. Since the drivers, debt and devaluation, are still present and growing, the probability favors higher highs over time. We are likely moving deeper into the first big wave of this move, closer to the point where the public begins to notice, but still far from the mania phase where everyone participates. Now we arrive at the most critical and perhaps the most disturbing part of this analysis. This is the section that separates the casual observer from the serious practitioner of wealth preservation. We need to talk about what happens when the price is no longer the only obstacle to owning precious metals. We need to talk about access, friction, and the inevitable reaction of the system when it realizes the exits are crowded. In the early stages of a bull market, your primary challenge is conviction. You are buying when people mock you. You are buying when the price is stagnant. But in the late stage of a bull market, your challenge becomes access. You are trying to buy when everyone wants it, when supply is tight, and when the system starts protecting itself. History teaches us that systems always protect themselves. When banking sectors get stressed, authorities invent facilities, create emergency backstops, and change accounting rules. We have seen this with every financial crisis. But the more practical risk for you, the individual, isn't just a dramatic bank holiday or a government confiscation order. Those are the movie plot scenarios. The real-world risk is much more subtle and bureaucratic. It comes in the form of friction. Imagine you decide it is finally time to move a significant amount of capital out of the banking system and into physical gold or silver. You initiate the wire transfer. Suddenly, your bank flags the transaction. They want extra verification. They require you to visit a branch in person. They ask you to fill out forms explaining the purpose of the withdrawal. They claim they are protecting you from scams or adhering to anti-money laundering compliance. While scams do exist, these blanket restrictions function as a form of capital control. They slow down the velocity of money leaving the system. Money sitting in deposits is the fuel for the banking machine. Money leaving to buy hard assets is oxygen leaving the room. The system has a direct incentive to make it inconvenient, expensive, and psychologically annoying for you to exit. This friction is already here. We are hearing reports from all over the world of delayed wires, lowered limits on daily transfers, and aggressive questioning from bank managers. This is not a conspiracy. It is an algorithm. Banks are programmed to retain capital. As the demand for metals rises, this friction will increase. And once the bureaucratic friction stops working, the next lever is taxation. Tax policy can act as a soft ban. Governments can impose windfall profits, taxes, transaction taxes, or premiums on the purchase of speculative assets. This keeps the market technically open, but raises the cost of entry so high that the average person is priced out. If you wait until the headlines are screaming about a currency crisis, you will be trying to enter a burning building through a door that is being slowly bolted shut. You will face wider spreads from dealers who have no inventory. You will face delivery delays of weeks or months. You will face a banking system that views your attempt to protect your wealth as a suspicious activity. This is why the concept of the builder versus the spectator is so vital. A spectator watches the price, feels the emotions of FOMO or fear, refreshes the browser, and does nothing. A builder has a boring, disciplined plan. They buy a set amount on a schedule, ignoring the noise. They understand that the best buys rarely happen when you feel brave. They happen when you feel slightly uncomfortable. We must also address the physical availability of the metal itself. Paper claims on gold and silver can expand infinitely. Derivatives, futures contracts, and unallocated accounts can be created with the stroke of a keyboard, but real metal cannot be printed. Industrial users, companies like Tesla, Samsung, and solar panel manufacturers, do not care about chart lines or paper contracts. They care about physical delivery. They need the metal to keep their factories running. When push comes to shove, industrial demand will drain the physical inventory, leaving the paper market disconnected from reality. This leads to a scenario where the spot price you see on TV might be one number, but the actual price to get metal in your hand is significantly higher. This decoupling is the ultimate signal of a broken market. We have seen glimpses of this in past squeezes where premiums on silver eagles or gold coins skyrocketed because the mints could not keep up. In the next phase, this could become permanent. You might see a spot price of $30 for silver, but find that you cannot buy an ounce for less than $50. In that world, the person who waited for the perfect pullback is left holding fiat currency that is losing value, unable to convert it into the assets they need. The banking angle is also frequently misunderstood. People ask, are the big banks short? Will they be squeezed? The answer is yes, concentrated short positions exist. But large institutions are not static targets. They adapt, they hedge. They can flip their positioning when the math changes. The danger isn't that a bank goes bust and you get a bailout check. The danger is that the rescue of the system involves printing so much new currency that the money in your savings account becomes worthless in real terms. The bailout is the inflation. The rescue is the debasement. This is why you hold metals. Not to speculate on the banks failing, but to insure yourself against the inevitable inflationary response to their failure. Consider the wealth transfer that occurs during these periods. It is not just about price going up. It is about purchasing power, moving from those who hold paper assets to those who hold real assets. When real interest rates are negative, meaning inflation is higher than the interest you earn, bondholders are being slowly liquidated. That purchasing power has to go somewhere. Historically, it flows into commodities, real estate, and precious metals. We are potentially looking at a massive rotation of capital from the bond market into the metals market. The bond market is in the trillions. The metals market is a tiny fraction of that. If even a small percentage of bond capital tries to squeeze into the gold and silver sector, the price impact will be explosive. So the question you must ask yourself is not, will the price go down next week? The question is, can I afford to be on the wrong side of this wealth transfer? The window of opportunity where you can easily exchange fiat currency for physical metal with low premiums and no questions asked is closing. It may not close tomorrow, but the trend towards restriction is clear. As the crisis deepens, the rules will change. They always do. The system will prioritize its own survival over your ability to transact. We have covered the technical breakout, the fallacy of the 2011 comparison, the importance of global benchmarking, and the looming threat of access friction. Now, we must distill this into a coherent plan of action. Information without execution is merely entertainment. If you agree with the thesis that the currency is losing integrity and that metals are in a structural bull market, you cannot remain passive. First, you need to decide what kind of market participant you are. Are you a stacker, a trader, or a mix? If you are stacking for protection, your goal is not to time every wiggle of the chart. Your goal is to accumulate ounces. You should be looking at the number of ounces you own, not just their dollar value. As the price rises, the number of ounces the average household can afford will drop. In the early days, you can add weight. In the later days, you will be fighting to add fractions. Do not underestimate the value of starting sooner. Establish a schedule. Whether it is weekly or monthly, consistency defeats emotion. This removes the psychological burden of trying to guess the bottom. If you are already positioned, your challenge is retention. When silver runs hard, you will be tempted to make emotional decisions. You might feel the urge to sell everything at once to lock in a gain, or conversely, to leverage up and chase the rally because you feel you didn't buy enough. Both are dangerous. You need a framework. Perhaps you keep a core position that you never touch. This is your insurance policy. Then you have a smaller speculative pile that you can trade or liquidate if you need cash. This mental separation prevents you from selling your lifeboats just because the price of lifeboats went up. For those who are new to this space, do not let the recent surge scare you into paralysis. A bull market climbs a wall of worry. It does not wait for you to feel comfortable. If you wait for the perfect entry, you might find yourself chasing the market at much higher levels. Start small if you have to. Buy 1 ounce, then another. The act of starting breaks the psychological barrier. You must also engage with the community. This is not just about watching a video. It's about joining a network of people who see the same reality. If you have been stacking for years, share your wisdom. Tell the newer viewers what schedule worked for you, what kept you disciplined during the long years of sideways chop. If you are new, ask questions. The comment section is a resource. It is a way to verify that you are not alone in your thinking. I want you to take specific steps today. If you have not subscribed to this channel, do it now. We are tracking this market in real time, and you do not want to miss the updates when the volatility picks up. Check the description for the resources we have mentioned, the premium channels, the deep dive research. These are tools designed to give you an edge. And if you are truly part of this community, drop the code phrase OGJohnAG in the comments. This lets me know who the serious people are, the ones who are actually paying attention to the end. Finally, answer this question for yourself and for the community. Over the next 12 months, do you believe the bigger opportunity lies in gold, silver, or the mining stocks? And why? This forces you to articulate your thesis. When you write it down, it becomes clearer. Remember, if gold and silver continue higher, it will not be because the world suddenly fell in love with shiny rocks. It will be because the financial system is leaking confidence. Metals are the universal language of, I don't trust this, if that is the environment we are moving into. You want to be positioned before the crowd arrives, and you want to be positioned before the friction makes it impossible to move. The game board is tilting. The rules are changing. Make sure you are holding the assets that have survived every currency collapse in history. Take care of yourself, take care of your financial future, and do not let the system catch you unprepared.